Hello everyone and welcome back. I'm assuming by now you've probably already had your Thanksgiving dinner as well as any pie, and probably also got to participate in a little holiday shopping frenzy. So let's go ahead and take a look at evaluating the management of fixed assets. There are two issues that are important when we manage fixed asset. One is a company needs to look at how productive they are in generating revenues with those fixed assets, as well as the ongoing condition of those assets. Companies need to keep tabs on that because the reason we have fixed assets is to help us produce revenue. So that is very important. And these measurements that will be going on helps us take a look at that. Well, here we are again with our horizontal and vertical analyses. I'm not going to spend a lot of time on here, as by now you are probably very familiar with these formulas. It's always the current year minus the previous year divided by the previous year for horizontal. And then for vertical, it's always going to be the account divided by total assets when we're looking at balance sheet accounts, and then the account divided by total sales if we're looking at income statement accounts. Now we're going to take a look at the fixed asset turnover ratio. We've looked at some of these turnover ratios for receivables and for inventory, as well as cash as we've been moving forward. So now it's appropriate for us to take a look at what these ratios mean in regards to fixed assets. So how do we find out if a company is using fixed assets productively to generate revenues? The fixed asset turnover ratio compares the total of revenues during a period to the average of the net book value of those fixed assets for the period. So when we take a look at here, we have total revenues divided by average net book value of those fixed assets. So again, how do we take a look at the average? We take the beginning net book value plus the ending and divide it by 2, just as we have done in Chapter 6 for receivables and in Chapter 7 for inventory. The key for you here is to realize what is net book value. I'm going to remind you here that it is cost, so cost of the asset, minus accumulated depreciation equals our net book value. In some instances, you may need to do this calculation. In some other instances, it may be given to you. Let's go ahead and take a look at an example here for McDonald's for 2008. Here they're giving us 2010. They're giving us total revenues for 2010. So looking at this should be for 2010, not 2008. Another error. I'm keeping track of these. The net book value has already been calculated for you. So the ending is 22 and the beginning is 21. We add both of those together, divided by 2, gives us 1.10, which is the ratio. So for total revenues for 2010, the average net book value of its fixed assets is 1.1 times. In other words, for every dollar of fixed assets on the average, McDonald's was able to generate $1.10 per every dollar of revenue. So what does that mean to us? We really can't see unless we go and take a look at some of our competitors. So what is Wendy's? Wendy's is 2.16. Burger King was 2.47. So what that means, for every dollar of revenue, Wendy's is getting $2.16. And for every dollar of revenue, Burger King is getting $2.47. So you can see that McDonald's trails behind its competitors in generating revenues from its fixed assets. You may be thinking about, what are those fixed assets for Wendy's, McDonald's, or Burger King? And in our case, it could be a fryer, it could be buildings. And so obviously the others are using those fixed assets better than McDonald's. But is McDonald's cheaper? So do they have to generate more revenue for their fixed assets to generate comparable to Wendy's and Burger King? That's something we'd have to take a look at as we move forward. So let's go ahead and take at what they mean by average life of a fixed asset. So what is the average life of a fixed asset? It represents the number of years on average that the company expects to use its assets, It's calculated by taking the average useful life So it's the average useful life equals cost of fixed assets divided by depreciation expense for the period. And we're going to work some problems out going forward. A higher number represents a longer useful life. So a higher number represents a longer useful life. So keep track of this formula because we're going to go back to that here in a minute when we go work some exercises. In addition to that, we can also take a look at the average age of our fixed assets, and this represents the number of years on average that the company has used its assets. It's calculated by average age equals accumulated depreciation divided by the depreciation expense. The higher number means assets are older. So a higher number means assets are older. All of these work better with what we determined the straight line depreciation is. So again, keep track of this formula as we go and work a couple of exercises. First, we're going to go ahead and take a look at an example for. Here is the average life and average age of fixed assets for McDonald's. The average life, we took the total assets divided by the depreciation and we get 28.7 years. And that would be total fixed assets. Here we take the accumulated depreciation, what's sitting in the count, by the depreciation expense, and we get 10.3 years. So what do these ratios mean? They mean that on an average, the expected life of McDonald's assets are almost 29 years and are currently about 10 years old. So that means that we're going to get another 19 years out of each of these assets. So now let's go ahead and move to some examples and do the computations together. So let's go ahead and take a look at page 208, and we're going to look at number 12. So when we look at number 12, it says, in its annual report, Fono Corporation reported beginning total assets of $360,000 and ending total assets of $406,000. Beginning fixed assets of $300,000 at cost and ending fixed assets of $311,000 at cost, ending accumulated depreciation of $106,000 and depreciation expense of the current year of $16,500 and revenues of $120,000. So if we go ahead and we take a look at our formulas, let's first write down the information that we are going to need to use. So we have beginning fixed assets equal 300,000. Okay. We also have ending fixed assets. So ending fixed assets is 311,000. Okay. They tell us that the accumulated depreciation at the end is 106, so that will help us compute the net book value. And in this case, we have to compute the accumulated depreciation by taking the 106, which is the ending, minus what was added during the period, which was 16,500, and that should come up with our accumulated depreciation prior to the end of the year, which in our case I would believe would be 89,500, and then that would give us our net book value in this particular problem. So that would be 210,500 for the beginning, and for the end would be 205,000. In addition to that, we have revenues of $120,000, and we have depreciation expense for the period of 16,500. So the first one that we're going to go ahead and take a look at is the average useful life. So average useful life equals the ending fixed assets. So the average useful life of fixed assets is going to be the ending fixed assets divided by the depreciation, which is 16,500, equals 18.8 years. The average age of the fixed assets, so the average age of the fixed assets is going to be the 106, which is the accumulated depreciation, divided by the depreciation for the time period, which gives us 6.4 years. And what this tells us is that our average useful life of our assets is 18.8 years, and currently our assets are at least on average 6.4 years old. Now in this problem, if we wanted to do the turnover ratio, which they also ask us for, we would take the sales of 120,000. We're going to divide it by the beginning, which is 210,500, plus 205, divided by 2, is going to give us 0.58. So what that means is for every dollar of revenue, we get 0.58 cents in usage of our assets. Hopefully this problem will help you as you go through and you do your homework.